Well, welcome everyone to another market update from Principal Wealth Partners. I am Julina Ogilvie, Partner and Director of Business Development. And I have here again our founder and CEO, Bob Paolucci. And we wanted to circle back and discuss the volatility that we continue to see dominate the media today, with concerns around inflation, Fed action, the devastation in Ukraine. And despite this wall of worry, we continue to see signs of optimism. So Bob, we had a recording not too long ago, but we're back with a purpose today. So I'd love for you to share that.
Yeah, thanks, Julina. This one is we're doing this because we went out on a limb in January, in February, with our prior market videos, and then again in April, just about 2 weeks ago. And we had mentioned in prior videos that inflation was likely going to peak sometime at the end of spring, right? Maybe sometime in the summer. And that couldn't have been more of a contrarian call at the time. Even 2 weeks ago, it was a contrarian call. And I'm happy to say that according to the report that came out at 8:30 this morning, inflation appeared to have peaked and has now trended lower for the first time in a year.
Right.
And it should be celebrated.
It should be, but.
And it is. But I should point out, if you're listening to this and you're hearing about the inflation report, if you go to CNBC right now, it's going to say something a little different. And it's really to pull out fear and emotion in you,
right?
That, inflation is still near record highs. Well, it's lower. I think the appropriate title should be "It peaked and it dropped." So this is updated. The trailing data is updated through 4:30, but we got this from a source that updated the lines down from 8.5 to 8.3, core CPI down from 6.5, 6.6 to 6.2. So we are headed lower, and that's a wonderful thing. And what comes with that? Well, what comes with that is what we have been saying. The cure for high prices is high prices, right? The Fed is saying they're trying to fight inflation, but they're really not. They are very likely just getting their tools back, right? They need to increase rates and taper away their bond buying program so they have the ammo needed to fight the next fight.
Whenever it may be.
Whenever it may be, if and when we enter a systemic slowdown that needs some type of stimulus to get it going again. Without ammo, you can't do any fighting. That's just the way it is. Mm-hmm. However, the Fed isn't stupid, of course. You should not fight them. Their words go a long way. And they know that in a scenario where they're pinned in the corner, their words can actually move mountains. And those mountains were yields in the bond market. So part of them paving the path to increasing rates was to talk about increasing rates, maybe to change their language, to say that inflation is hot and yes, it's still transitory, but because the Fed didn't define it, they stopped using the word. That will give us the ability to increase rates. The economy is so strong that it doesn't need to be supported anymore. We think the capital markets, the economy can tolerate slightly higher interest rates. Now, they said that in January and did nothing until March. But the bond market did something very unusual. It took the Fed's vague statements and priced it in immediately. Mm-hmm. What I mean by that is normally when the Fed moves, the bond market will react to a move, not to the words.
Right.
In this environment, the bond market moved as soon as the Fed opened their mouth. And they priced it all in. And by that, I mean, if you listen to any financial media, you heard Goldman Sachs and JP Morgan and all these smart investment banks say that rates are going to go up by 15 times this year.
Right.
They're going to hike rates 15 times, 13 times. There was someone out there 16 times. There was someone calling for 100 basis point or hikes, moves 4 times this year. Amazing.
Yeah.
It was almost like who could have the higher number. Talk about ego. So all of that was priced in very quickly between January and the end of February, and there was a small adjustment in March.
Right.
But the Fed didn't do anything until March, right? They increased by a quarter, and then they increased again last month at our last video by 50 basis points. That's
right.
it.
And Bob, as we discussed in the last video, that's one of the reasons we think a lot of the volatility is behind us, especially on the bond side, correct?
Yes.
Because it was priced in immediately.
I think the move in yields, at least in the short term, has been overdone. Any move in yields very likely going forward is going to be at a much more moderate pace.
Right.
And that does less devastation. It might not do anything really to the bond market, unless you own very long-term bonds. We don't own any of that stuff.
Correct.
But in short periods of time, the equity markets are linked to the bond market. So what I mean by that is, if you look at the NASDAQ and you chart the NASDAQ against 10-year treasury bonds, they are like 1-for-1 synced up. Right. Now, I can tell you that that's a program trade that many quants who think their stuff is so unique are all doing at the same time. Right. So a lot of these computer program models, risk parity models run by all these hedge funds that lose everybody's money, they are all synced up together doing the same, what they think is unique thing. And unfortunately, when they sync up, there's hundreds of billions of dollars, in some cases, trillions of dollars, when you factor in the leverage that they use, that moves markets day to day.
Right.
So this is why I try to tell investors, don't worry about what the quants are doing. They have to move money. They have programs that move money without emotion, without looking at fundamentals, and they're just trading data.
Absolutely.
Unfortunately, they invest in the same sandbox, or I'm sorry, I shouldn't say it that way. They play in the same sandbox that our investors invest in.
Absolutely.
Should there be a high-speed lane for them? There really should be, because I don't think it's fair.
Right.
Does my opinion really matter? Not at all.
You can voice it.
Yeah, at least I have some self-awareness. So ultimately, the volatility in the market is mostly driven by a knee-jerk reaction in rates, and we think that's overdone. We think the sell-off in the market is overdone, at least for the top half of the market, which is more quality than the bottom half of the market. So, companies that need to borrow tons of money yearly or quarterly to run their company, you probably don't want to be invested in those in any scenario. Certainly in a scenario where interest rates went from nothing to something very quickly. And that's why, the bottom half of the NASDAQ and small caps are getting obliterated. I should also mention that we're seeing the downside of indexing.
What does that mean?
What that means is, you look at, the big index where all the money is, the S&P 500. It is a cap weighted index. The biggest company has the biggest weight.
Exactly.
So when money flows into it, every dollar that flows into the S&P 500, about 25 cents goes to about 4 or 5 companies. 75 cents goes to 495 companies. And it's all fine and dandy when money comes in, right?
Right.
But what about when money comes out? What if you want to sell the bottom of the S&P 500?
How do you do it?
You have to sell the S&P 500.
Right.
So all those mega cap quality companies that pay dividends, grow earnings, grow dividends, buy companies that have hundreds of billions of dollars in cash on the sidelines, they get hurt. Yes.
Right.
They benefited on the way up. They get hurt on the way down. And that has been happening.
And Bob, that's one of the reasons, and we've talked about this in the past, that the return of the S&P doesn't always give the pure picture of what's going on in the market.
Never gives you the understanding of what actually happens in the market.
Right.
Yeah, you have to look inside of these indices to see what's really going on. And I believe, Julina, on prior videos, we did the internals chart.
Yes.
Showing people that, 60% of the NASDAQ has fallen 40 to 50%. 40% of the S&P has fallen by 40% or greater,
Right.
but the index has not. When you glue it all together, it's a little bit more stable, but there is carnage that has happened beneath the surface. And I call that a stealth correction.
Absolutely.
So everyone's looking for 20 and 30% pullbacks. It's happened.
Right.
But as a united index, it hasn't. Why? Well, you have value stocks, companies that historically grow earnings pretty slowly, but you get earnings pretty consistently, and they pay decent dividends. They have weathered this storm a little bit better than growth companies who pay little to no dividends, but they grow their earnings by 4 times as much as value companies.
Right.
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 That part of the market has held up at a time where a good chunk of the market, primarily technology, has sold off.
And by the way, that's a complete reversal of what we saw coming out of the pandemic in
Correct.
2020.
Correct.
Yeah.
Yeah. And it doesn't mean it's right. It just means that there was a reaction to higher interest rates. The flavor of the market has changed a little bit.
Mhm.
There's no appetite for very speculative companies that should be out of business anymore.
Right. Absolutely.
I just said that, but I can't believe that there was 9 months ago, 24 months ago. So really the bottom of all these indexes are getting bludgeoned, as they should.
Mhm.
But unfortunately, they get bludgeoned by selling those securities, shorting them, and then people selling the indexes. And unfortunately, quality sometimes comes down with it.
Right.
So I look at this market and I say, wow, what a higher quality, higher yielding, dividend growing environment. What a great environment to be invested in.
Right. Another reason for optimism.
Here we are.
Yeah, absolutely.
Yeah, and not only are yields higher in the stock market, yields are significantly higher. I mean, 100% higher in the bond market.
Right.
I mean, that's as aggressive as I'll get with marketing. By 100% higher, yields went from barely yielding anything to now having a quasi normal yield, from 1.5% to 3%.
And these occurrences historically
Not
are
great, but it's
rare.
it's a heck of a lot better than 1.5% dividend rates, bond rates.
Absolutely.
So yeah, I'm incredibly optimistic, even though I think the market might have maybe 2 to 3% more to go potentially. And it's really the NASDAQ that might drive it.
Mhm.
There might be some left in the NASDAQ. Why does that impact the S&P 500? Well, many of the companies in the NASDAQ are the biggest companies in the world that happen to show up in the S&P 500. That's just it. The NASDAQ is where stocks are traded, New York Stock Exchange or the NASDAQ. Those companies tend to be healthcare, technology, growthier, more speculative companies.
And also smaller companies too, correct?
And then you have smaller companies. You're absolutely right.
Okay. No, thanks for clarifying that.
Yeah.
There was something else that occurred last week that caught our attention. We always talk about what happens when the media capitulates, and not to pick on one media outlet, but we will. CNBC had a study that came out last week. Can you share with us what happened?
Yes, your favorite slide, is that the one you're talking about?
It is, yeah.
Yeah. This is one of the rare perfect indicators in history. When the markets get very volatile, CNBC or any really media outlet likes to capitalize on the fear and instill more.
Sure.
They have markets in turmoil, and that's actually the name of their segment. So they knock out Jim Cramer and they put on this segment called Markets in Turmoil. And that segment is when they frown and they speak negatively and they shake when they talk and they talk really loud and they interview people, and they're only looking for bad news, right? Tell us what happened. The market got hammered today. What's going to happen?
Pummeled too.
The market got pummeled. That's actually the word they use, pummeled. And they start showing pictures of animals on CNBC, like a bear eating a bull or something like that. I mean, I'm telling you the truth. You can look it up yourself.
And the screen turns red.
And the screen turns red. The entire screen turns red. So here is a chart, one of the most amazing charts you'll ever see, of 1 year after the broadcast of every single markets in turmoil broadcast. And 100% of the time, since they started doing these markets in turmoil segments, starting in 2010, and every single segment charted, the market is positive by double digits. It is fascinating how accurate this is. Sorry, it's 100% it's positive. There were only 2 times on this chart where it was single digits, and that was in 2018. It was positive 4 and 9%. Every other time it was positive double digits. And then they have a tally on this chart that shows returns since markets in turmoil. So if you reacted negatively, or if you jumped out of the markets in 2010, 2011, when they started doing this, 12 months later, the return was on average 25%. But returns since then, if the markets in turmoil segment knocked you out of the market, you would have missed a 400% return in the market. So it's just fascinating. I think there should be some accountability in the financial media when they fearmonger, when they make you feel awful, when they knock you off the horse. But there is none, and they sell ad space when they do this stuff. So turn off the TV, I guess, is what I'm saying in a roundabout way.
It's hard not to grab your attention, though, for sure.
It's hard, right?
It caught ours, and then we laughed.
Yeah, but just think about, we oftentimes, our clients and us, we often talk about, money provides freedom. Doesn't provide happiness. It can provide sorrow, but it gives you freedom. And if you have that freedom, you can do other things with your time. What you shouldn't be doing with your time is wasting it looking at CNBC or watching CNBC's markets in turmoil segment.
Right.
What a waste of time. Go play with your grandkids or your partner or your cousins, or go outside, or go golfing, or go hiking, or go do some push-ups. Go to the doctor even. It's better to do that stuff than to waste your precious time that we are all running out of. Especially if you're watching this video, you have money and you have freedom. Use it wisely. I don't like when people get anxious about things they truly don't know about. And that's a cocky statement, and I'm not trying to be a smart aleck here. But ultimately, if you don't know the inverse relationship between bond yields and prices, what happens to the NASDAQ when the 30-year goes up or the 10-year goes up or down, you don't understand relative strength indexes. You don't understand that when a company pays a dividend, it decreases its stock price. Then you should turn off the TV, stop even reading the Wall Street Journal, and go have fun with the rest of your life. And that's if you're 30 years old listening to us, 70 years old listening to us, 90 years old listening to us. If you're listening here, you're working with a qualified financial services firm that is trying to help you live a better life. And part of that is to protect you from the mania that the media creates, and advertisements and commercials on various news channels.
Absolutely.
So,
and again, this is the reason we have a process and we have an investment committee, and it is a thoughtful review constantly of what is going on in the economy and the markets overall.
Absolutely.
Yeah. So thank you for sharing that.
And at some point, for whoever's listening to this, we can certainly lay out the hundreds of indicators that we look at and know how to look at.
You're going to put everyone to sleep.
I know, and I'm willing to do it for anyone who wants to.
I know you are.
But I say that because that's really most important.
Sure.
Dividend yields are up, earnings are up. You're invested, if you're doing business with us, you're invested in quality companies. If there's any speculation, it's marginal stuff, like 1 or 2% pieces. So you can sleep at night. You're going to do very well over a very long period of time, and you're going to do very well over a short period of time. It's all on how you define it. I would say you give us 3 years, ask any of our investors how well they're doing. You give us 5 years, ask all of our investors how well they're doing. Give us 10, you won't have to ask any questions. So
absolutely.
Things are
Thank
good.
you.
Staying invested is difficult. And if you don't mind pulling up one of my favorite charts. Great. So one of my favorite charts, Julina, as I was mentioning, is chart of the S&P 500 since 1928. There are 2 columns here, well, 3. You have the calendar year, you have the drawdown intra year, and you have the total return for the year, how it finished.
And Bob, really quickly, the drawdown is basically the worst experience within that year in the market.
Yeah, during the year. And an example that everyone will obviously relate to is in 2020, when the pandemic started and the world shut down, the month of March of 2020, there was about a 34% drawdown. That actually happened in a month, March, but then that's not the way it finished. In 2020, the market finished up about 18%.
Right, and that's highlighted on the bottom right-hand side of the page in dark red.
So to get that 18% return, you had to tolerate a 34% decline.
Correct.
Right. So where you are during the year never reflects where you are at the end of the year. It never has in history. Right. Market proof. If you look at the TR, total return column, on this chart, you will see a lot more green than you see red. However, in every drawdown, every DD column, every single year, there's a drawdown. And
guaranteed.
Guaranteed. The drawdown average is about 16.8%. And guess what the market has drawn down? The S&P, 16.8%. So what I'm saying in English is the market has reached the level that is average. Uncomfortable for everyone, but average. And whenever it reaches that level, it tends to not stay there, right? It tends to go the other way. And I'm very optimistic that that will start happening very soon if it hasn't already started to happen while we're speaking. So, and I'll summarize this chart for you. Again, I think the quote is so important to understand. The stock market, according to Warren Buffett, is a device for transferring money from the impatient to the patient. And if you really digest that, there are investors who would love to buy your Apple that grows earnings by 30% a year and pays a dividend at a 24% discount if you would love to sell it to them at a discount.
Right.
So if you are impatient enough to sell your quality stuff at a discount, there is someone very patient who is willing to buy it. And you have to understand that. And don't let your emotions take over. And, use us, your therapist, advisor, to help you along the way, because we will. We've invested in these markets throughout our entire career. We know how it works. We know why it works. And we have these senses where we understand when everyone gets anxious. It's obvious. Nobody likes down markets, but without them, you'll never have an up market.
Yeah, absolutely. And as ridiculous as your comments might seem to some people, when we look at flows in the industry and the money that is leaving equities right now, we see this happening to many investors.
Yeah. And Julina, if there's another market video that we do this year, keep in mind, we only do them when the markets are down. If there's another market video, I think we should pull up a chart of average investors over the past 20 years, which is measured by looking at flows in and out of stock investments and funds from Vanguard, Fidelity, JP Morgan, all the big firms.
They all have them. Yeah.
And they deduce from that, it's a very famous study, is that the average investor, the average individual investor doing it themselves, their return over a 20-year period tends to be about 2.9%. And the 2.9% versus an average 60-40 return or the S&P 500 return, the difference is emotion.
Mm-hmm.
Period.
Absolutely.
Story. It's emotion. People tend to do the wrong thing when they're most emotional, and that works in two ways. Number one, when they get 50% returns in a short period of time, they forget about the downside and they just want to take more risk, and they start asking you about mining for cryptocurrency and doing all this crazy stuff that is out of their risk profile. Right. But then when the markets go down just a little, especially if they go down after a big up, it's much more emotional. They start to ask you about buying Campbell's Soup and Clorox and companies that barely grow their earnings over time. And should I buy savings bonds? Should I buy gold? Should I buy, should I put money in the mattress? So on and so forth. So, if there could just be much more balance to client emotions, and I'm not saying that our clients are emotional, but investors in general, if they could just be much more balanced and have a fundamental understanding that without risk, there is no return.
Absolutely.
And, you have to tolerate volatility in the markets to get very good compounded returns over a long period of time. Mm-hmm. There will be a lot more wealth for everyone.
Absolutely. And I think your comment, and investing is emotional. We know this, but I think how you manage the emotion is what's critical. And you actually have one other slide, I think, that helps talk about that psychology.
Absolutely. Pull it up. Is that the emotional chart, which happens to be a market cycle chart?
We have a lot of emotional charts, but this is one of them.
Yeah, this is a good one. So I think you've all heard of the acronym FOMO, which is fear of missing out, right?
My daughter taught me that.
Yeah. So, when Tesla goes to 1100, now everyone wants to buy it. So that's fear of missing out. When cryptocurrency goes to 60, Bitcoin goes to 68,000, now everyone wants to dabble with it. Well, you fear missing out. You want to be a part of the game. And that usually creates a top. But there's also another acronym that I like to use, POMO, point of maximum opportunity. And the point of maximum opportunity is when everyone is angry, there's capitulation, panic, and depression. That is the point of maximum opportunity.
Right.
Don't contribute to it. Don't give your money away during angry, capitulative, panic, depressed times, because you are giving your wealth and creating wealth for someone else. And that's a very charitable thing to do. So give it to charity, but don't give it to a stranger, and don't give it to a hedge fund, and don't give it to a quant trader because they don't need it and they don't deserve it. So hold on to your good stuff. And hopefully, if we're doing a good job, we'll accumulate more good stuff at the point of maximum opportunity, which is when everyone gets nauseous from what's going on in the capital markets. So
absolutely.
This makes a lot of sense. It's the roller coaster of emotions. Euphoria happens at the top. I don't think anyone gets euphoric, maybe other than us, at the bottom. And it makes sense, right?
Absolutely.
Yeah.
Yeah. No, thank you for sharing that.
Great.
So, I think in summary here, our thoughts are, I love the POMO. I hadn't heard that before. We have to be closer to that point than anything else, given everything that we're seeing out there in the markets and relative to the return that we're seeing of the stock and bond market. If that's fair to say.
That's fair to say. Yeah. And the market appropriately adjusted to interest rates that are much higher. However, interest rates have never moved this fast, right?
Right.
And the market had to react to it from a technical standpoint. And it created some emotion, and emotion sort of deflated the bubble that was in the bottom of the indices, maybe the speculative stuff that doesn't have any earnings and might never have any earnings. And that's healthy. That's healthy. So the market's in a much better place. There are parts of this market that are just outright cheap, and most of the other parts of the market are fairly valued. The market never stays at fair value for long because earnings grow, companies get acquired, there are transactions. The companies in the market, they figure it out, and if they
Absolutely.
CEOs get fired pretty quickly. So I think there's a great opportunity here. You will see us rebalance portfolios if you're listening. We've actually already done some. If you're really paying attention, check your email. You'll see trade confirmations. Again, if your portfolio warrants a rebalance, generally speaking, we own good stuff. If that good stuff came down in tandem to a degree,
Right.
then and your allocation hasn't changed, then it really doesn't warrant a major allocation change. It just means the market will likely go up from here. If your portfolio needs to be upgraded, we're doing that. If it doesn't, it's going to stay roughly where it is. So stay tuned.
And I think that's a fair point in saying that even if you didn't see a rebalance and you're a client of ours, it doesn't mean we didn't look at your portfolio.
Oh, of course not. Yeah, it's, on average, we look at portfolios, we look at positions on a weekly basis. We look at portfolios generally on a, surface scratching level monthly, and we take a deeper dive on a quarterly basis. Whether that's you or not, you should know that. That's one of the fiduciary duties that we have to our investors. So,
no, thank you for sharing that.
Yeah. So it's I think we're in a much better place here, and I really think what triggered that was really inflation peaking. It was the market exhaling. What you did see, and I should mention this, and this is why you can't react to the media. You can't react to the emotions that you're feeling. This morning, the inflation number came out, and all the headlines didn't really express what happened appropriately.
Right.
The truth is, inflation is trending down, and none of the headlines really said that. The headlines actually said something else. Inflation remains red hot. And you have to understand that keyword search algorithms are real. Look it up. And a lot of these program trades use keyword searches to trade pretty quickly.
Right.
What does the Fed say? What does inflation say? What are people talking about? What's the consensus talking about?
Right.
And it's driven by headlines. Literally, it's AI. It's artificial intelligence. I'm not making this up, and it sounds silly, I know.
But the market's reacted from that.
But Julina, this morning, we can point it out. We were talking about this before we went live with this video. The futures market, again, which I explained in last video, are traded by nobody listening to this recording, nor us, nor any real fiduciary financial advisor working on your behalf. It's all quantitative stuff, right? The futures were very green ahead of the inflation report, with the expectation that inflation would trend down.
Correct.
And then the number came out, but the words used by the media outlets did not necessarily indicate that inflation went down.
Correct.
So for the futures, after about 90 seconds, went way down. As soon as the report came out and the headlines were confusing, there were billions of dollars traded in the futures market based on bad words, wrong keywords, and that has since reversed. So the market is now green. That doesn't mean it's going to stay there, but just think about all the carnage that was created by reacting to those keyword search programs.
Absolutely. Thank you for going through that. It's a great example of the short-term volatility.
Yeah. So don't be fooled when you watch TV every day into thinking that fundamentals of companies change every nanosecond. They don't. They don't. That's just not how it works. Shares, the outstanding shares that are traded, some of them trade every day. That's it.
Absolutely.
What goes on at most big businesses? Well, if you own Costco, right? Go to Costco. Nobody's really talking about their stock price. They're stocking shelves and selling stuff and checking people out at the register and all that stuff. You walk into an Apple store or the Apple headquarters, they're trying to plan out their next iPhone. and how to, charge you more for cloud storage and all the other stuff that they do.
Right.
There's no day to day, there's no indication of what's going on with the fundamentals of any company, to be honest with you.
Absolutely.
So don't think that's the case when you hear all these shows talking about your best trade for tomorrow.
Mhm.
That's just silliness. So, anywho, Julina, that's really all I had. If you wanted to chime in with anything else, feel free.
No, I think I think that's a great way to end this segment here with, again, we always talk about the fact that the short term is based more on emotional reaction versus the fundamentals. And, having this video so quickly after the last one, I think hopefully people will understand why we did it. There was so much that transpired over the last couple of weeks, and we will continue to update everyone as the markets move forward. And, as always, we're here for you. If you have any questions, comments, please feel free to reach out to us. And Bob, thank you again for your insight. And
thank you, I appreciate it. And just to go on top of what you said there, yeah, we're here for you. If you need to chat with any of us, we're all available to you. And if there's anything that we can do for you, feel free to email, call, reach out, whatever it might be. So keep your chin up, as they say. Keep smiling. Use your freedom wisely. Don't waste it watching terrible news, financial news media.
Mhm.
And get out there and get traveling again. Go see your family. Go spend time with loved ones. Go play some games. Go enjoy your hobbies, and worry less. Because the markets are doing what they normally do, even if it doesn't feel that way.
Welcome back to normal markets.
Welcome back.
So thank you, Bob, and thank you everyone for listening.